PE ratio and its importance. Hello everyone, I'm Rakshit Pai, and in this video we'll talk about the PE ratio, various types of it, and how important the ratio is in your stock selection. So let's start today's topic. What is the PE ratio? Here PE stands for price to earnings ratio. It means what price you are paying in return for the earnings that you get. It is one of the simplest method of valuing a company. Here we are just saying what the company's current earnings are and what we are paying to be owner of those earnings. But is it really that simple? Well, let's see. Types of PE ratio. There are three types of PE ratio. Number one, PE TTM earnings. Here TTM stands for trailing 12 months, basically for the data of the past 12 months. That is the basic PE ratio, the actual ratio. It's also called absolute PE ratio. Number two, forward PE ratio. Here we try to estimate what the future earnings of the stock will be and then what the PE ratio of that stock could quote. When we compare the company's PE ratio to that of its competitors, we call it relative PE ratio. And number three, forward PE ratio for 1 year. Same as the forward PE, but for the next immediate 1 year. So it's an estimate for the next 12 months earnings in regards to the stock price. Why is PE ratio important? PE is the primary and most basic tool used by investors in evaluating whether the company's share price is undervalued or overvalued. It's easy to use and easily accessible in the sense that the two components, the price and earnings, are easily available in company's CAR and quarterly reports. But is PE the right tool to use? The major issue with the PE ratio is that the denominator, the earnings numbers, can be manipulated. Here, earnings can be artificially inflated or suppressed as per the requirements of the management. Before going in depth about the PE ratio and its application, let's hear about ET Money Genius. ET Money Genius helps you to find the best mutual fund that's specifically catered to your needs, tailor-made for you based on your risk profile. So next time you think about investing, think about ET Money Genius. To check out more, check the link in the description. So what are the accounting aspects that impact your PE ratio? Number one, equity investments and other incomes. When we say earnings, we mean that the net earnings, which include other incomes that can be literally anything. For example, in the March month of Q4 2022, Exide Industries sold its insurance branch, Exide Life Insurance, to HDFC Life Insurance. When that happened, the earnings per share of Exide Industries went up to rupees 46.58 per share, where the previous earnings were just rupees 2.10 per share. See the difference here? Number two, accruals. Here accruals means any payment or receipts that's not yet made but written in books for the future. For example, payments such as accounts payable, depreciation expenses, accrued expenses and liabilities, and receipts such as account receivables, deferred revenue, etc. These accounting transactions undermine or overshadow the company's actual earnings, thus directly impacting its PE ratio. Number three, price hike. I mean, the current market price of the stock shoots up or crashes down for reasons other than company's financials. And such sudden movements in share price will make the PE ratio seems favorable or unfavorable at times. I don't think you need better example than the Adani Group companies. Check out Adani Group company's PE ratio in the last week of January and the same in the last week of February 2023. See how much of a difference a month's drop in share price has made in the PE ratio. Number four, cyclical. There are a whole bunch of companies that earn their earnings in a seasonal manner. We call them cyclicals. When the company's earnings go up in certain quarters, its PE makes the company seems undervalued just for these quarters. For example, you can check out any commodity-based PSU company such as Hindustan Zinc Limited, Hindustan Copper Limited, etc. Number five, growth companies. You can never find an undervalued company based on its PE ratio if what you are searching for is a growth company. In its initial stages, maybe yes, growth companies may give you low PE. But for aggressive growers that has passed the mid-cap stage and are at the large cap stage, you will never find such companies to be undervalued by the PE ratio metrics. So if you depend just on this ratio, that is the PE ratio, you will have to forgo companies such as Britannia Industries, Nestle, HUL, etc. These companies will not be available at a P ratio below say 20 or 30 unless you are buying them at the bottom of the market crash. Conclusion. There is nothing wrong with the P ratio. In fact, it's the simplest way to see whether the company is living up to its expectations. Here the expectation is earnings. But since the earnings number can be fudged, we must be cautious when relying on these metrics. Basically, use the P ratio but know when not to use it. I hope the video was informative. Don't forget to check the link in the description. Until next time, thank you for watching.